Friends, thank you for being here today. It is rare in the world of finance that we can pinpoint a specific moment when the gears of the global machine grind to a halt. Usually, markets erode slowly. They degrade over months or years of mismanagement until they simply cease to function efficiently. However, what we have witnessed over the last 48 hours, specifically since the announcement on Sunday, January 18th, 2026, is not an erosion. It is a fracture. A clean, immediate break in the logistical pipeline that has held the Western financial system together for decades. If you have been watching the mainstream news, you are likely inundated with stories about Greenland. The pundits are having a field day. They are cracking jokes about real estate deals in the Arctic. They are interviewing Danish politicians, feigning outrage. They are treating the president's renewed interest in purchasing the island as the eccentric sideshow. If you rely on the television for your understanding of the world, you would be forgiven for thinking this is a political circus with no impact on your portfolio. But while the media laughs, the risk managers at the world's largest bullion banks in London, New York, and Hong Kong are not laughing. They are staring at their screens in a state of absolute crisis. Because buried within the president's executive maneuver, hidden behind the headlines about ice sheets and sovereignty, is a single policy detail that acts as a nuclear event for the global silver market. President Trump has announced a 10% tariff on all imports from 8 European nations, including the United Kingdom, effective February 1st. If a deal for the territory is not reached, the tariff escalates to 25% by June. To the layman, this is a trade dispute. To the veteran market analyst, and to those of you who understand the plumbing of the financial system, this is the end of fungibility. It is the moment where the assumption that an ounce of silver in London is equal to an ounce of silver in New York dies. Today, we are going to set aside the political theater and dissect the cold, hard logistics of what has just happened. We are going to explain why this Greenland Tariff has effectively turned the United States into a Roach Motel for precious metals, and why the London Bullion Market Association, LBMA, has just been cut off from its life support. To understand the severity of this tariff, we must first dismantle a common misconception held by most investors, though likely not by seasoned observers such as yourselves. We tend to view the silver market as a singular, fluid ocean. This concept is called fungibility. It is the bedrock of modern commodities trading. For a global futures market to exist, the asset must be interchangeable. The only reason a trader in Singapore feels comfortable buying a contract for delivery is because they know that, if necessary, metal can be moved from where it is plentiful to where it is scarce to satisfy that contract. For the last 40 years, the major bullion banks, entities like JP Morgan, HSBC, and others have maintained this illusion of a unified market through a process of constant logistical arbitrage. It is a game of whack-a-mole. When demand spikes in New York and the price on the COMEX, commodity exchange, begins to rise above the price in London, the banks act as firemen. They withdraw silver from their vaults in London, the LBMA, put it on a cargo plane, fly it across the Atlantic, and deposit it into the COMEX vaults. This flood of new supply pushes the New York price down, keeping it in line with the global average. Conversely, and this has been the more common dynamic in recent years, when London runs dry due to massive physical buying from India and China, the banks reverse the flow. They take silver out of New York, fly it to Heathrow, and refill the London shelves to prevent a default. This constant bidirectional flow of metal is the heartbeat of the price suppression mechanism. It allows the banks to pretend there is always enough silver because they can simply shuffle the same inventory back and forth to wherever the fire is burning hottest. It relies entirely on one variable. The cost of transport must be negligible. As of yesterday, that variable has been eliminated. The cost is no longer negligible. It is prohibitive. Let us look closer at the new reality introduced by this 10% tariff on United Kingdom imports. The United Kingdom is the home of the LBMA. It is the physical hub of the global silver trade. Under the new executive order, any good entering the United States from the UK is subject to a 10% tax on its value. Consider the dilemma of a bank risk manager this morning. Let us hypothesize that silver is trading at $90 per ounce. The bank sees that London is critically short on metal, a fact we have known for months as we watch the vault data deteriorate. In a normal world, the bank would ship 1 million ounces from New York to London to stabilize the market. There is no export tax to leave the US, so the metal flies out easily. However, the risk manager must ask the critical question, what happens if I need that silver back? Markets are cyclical. Next month, the demand might shift. The COMEX in New York might experience a squeeze, or the bank might need to settle a futures contract in the US. They would need to bring that 1 million ounces back from London. But now, re-importing that silver triggers the tariff. The metal is coming from the UK. Customs will demand 10% of the value. At $90 an ounce, that is a $9 tax on every single ounce. In the world of high-volume bullion trading, margins are measured in pennies, not dollars. A $0.10 spread is considered profit. A 9.0 Zort cost is a catastrophe. It is a nuclear bomb. It wipes out the equity of the trade entirely. Therefore, the bank cannot send the metal to London. Even though they could physically export it, they cannot financially risk it. If the metal leaves U.S. soil, it faces a 10% devaluation penalty to return. It effectively becomes stranded capital. This destroys the arbitrage. It stops the whack-a-mole game cold. The banks can no longer smooth out volatility by moving metal because the cost of the return trip is mathematically fatal. President Trump, perhaps inadvertently or perhaps with calculated precision, has placed a 10% tariff wall in the middle of the Atlantic Ocean. This brings us to a concept in logistics analysis known as the Roach Motel effect. The slogan for the old insect traps was simple. Roaches check in, but they don't check out. We are now seeing this applied to strategic commodities. Silver can check into the United States, perhaps from non-tariff nations like Mexico or Peru, but it cannot check out to go to London. Why? Because once it enters the LBMA system, it is tainted by the potential tariff cost of returning. This creates a trapped inventory scenario within the United States. On Sunday night, as the news broke, computer algorithms and human traders alike began to realize that the logistics chain had snapped. The silver currently sitting in COMEX vaults in New York, roughly 280 million ounces, though much of that is not available for sale, is now effectively domestic inventory. It is locked here. I want to pause here and ask for your perspective. Does this Roach Motel logic make sense to you, or do you think the banks have a loophole I'm missing? I'd be very interested to hear your thoughts in the comments section below. This creates a paradox that many amateur investors will struggle to understand. They might assume that because silver is trapped in the US, the price in the US will crash due to oversupply. This is incorrect. The price in the US is likely to rise, but the price in London is likely to explode. We are witnessing the bifurcation of the Western silver market. We are moving from a unipolar world of the silver price to a multipolar world of regional pricing. To understand the full gravity of this, we must look across the ocean to London. The LBMA has been the clearinghouse for the world's silver. It is where the massive industrial orders are settled, and more importantly, it is the conduit through which silver flows from the west to the east. For the past 3 years, we have documented the Shanghai vacuum. China and India have been buying physical silver at a pace that far exceeds global mining production. They have been draining the LBMA vaults. The float, the amount of silver actually available for sale in London, is at historic lows. London has been surviving on a lifeline. That lifeline was the ability to call upon New York for reserves. When the vaults got too low, they borrowed from Peter, New York, to pay Paul, Shanghai. The Greenland Tariff cuts that lifeline. If U.S. banks refuse to ship metal to London because of the tariff risk, which they must do to preserve their solvency, then London is isolated. It is an island, both geographically and financially. Starting today, London must survive on whatever metal it currently holds, plus whatever it can attract from miners who are willing to bypass the U.S. But the miners are already contracted. The supply chains are rigid. You cannot simply redirect 1,000 tons of ore overnight. This puts the LBMA in a state of immediate physical distress. Without the ability to source metal from the U.S. stockpile, where does London get the silver to settle its contracts? Where do they get the metal to send to India? They don't. This is the recipe for a force majeure, or cash settlement event. It is a soft default. We are likely to see the London price disconnect to the upside. We could easily see silver trading at $110 in London while it trades at $90 in New York. Why? Because in London, you cannot get the metal. The price must rise to destroy demand. In New York, the metal is present, but it is locked behind a wall. In economics, there is a principle known as the law of one price, which states that in an efficient market, identical goods must have the same price. If they don't, arbitrageurs will buy the cheap one and sell the expensive one until the prices converge. The executive order regarding Greenland and the UK tariffs has essentially repealed this law. Arbitrage requires movement. If you cannot move the metal without a 10% penalty, the prices cannot converge. The spread will remain. This is a nightmare for the bullion banks. Most of them run global books. They might be long silver in London and short silver in New York, assuming the two positions hedge each other. If the prices disconnect, if London rips higher and New York lags, their hedge blows up. They start losing billions on the spread. To save themselves, they will have to close their positions. They will have to buy back their shorts in New York and sell their longs in London. Ironically, this panic buying to unwind the hedge will drive the US price higher as well. We must also consider the geopolitical angle, which appeals to the pragmatic nature of our generation. We understand that nations do not have friends. They have interests. Whether this policy was designed as a negotiation tactic for a real estate purchase, or whether it was a 4D chess move to secure critical resources, the result is the same. The United States has just created a domestic strategic silver reserve. For years, defense analysts have warned that the U.S. is dangerously dependent on foreign imports for critical minerals. Silver is not just a monetary metal. It is the most conductive element on the periodic table. It is essential for Tomahawk missiles, for solar panels, for electric vehicles, and for the entire digital infrastructure of the Department of Defense. The U.S. Mint has frequently had to shut down production of silver eagles due to a lack of planchets, silver blanks. This was a national embarrassment. The Greenland Tariff solves this problem instantly, albeit bluntly, by making it financially toxic to export silver to the UK and potentially the wider EU. The administration has forced the metal to stay home. The silver sitting in New York vaults is now captured capital. It is available for Tesla. It is available for Raytheon. It is available for the U.S. Mint. It prioritizes domestic industrial security over the profits of international banking conglomerates. It sends a stark message to our European allies. You are on your own. The United States will no longer allow its vaults to be raided to suppress the price of metal in London or to feed the insatiable demand of China. This is America First, applied to the periodic table. It is resource nationalism. We have seen Indonesia ban nickel exports. We have seen China restrict gallium and germanium. Now, we are seeing the United States effectively restrict silver exports via taxation. Now, let us bring this down to the street level, to the decisions you have to make regarding your own holdings. You might ask, if silver is trapped in the U.S., won't that make it cheaper for me to buy? Likely not. And here's where the complexity of the supply chain bites us. While the raw stockpiles are in New York, if the tariff language covers all imports from these regions, then the cost of importing refined silver products just went up by 10%. Furthermore, if the U.S. dealers, like APMEX, JM Bullion, or your local coin shop, need to restock, they are now competing for a pool of domestic metal that has been walled off, but the refiners they buy from are facing higher costs. This will lead to an explosion in premiums. We have discussed the difference between the spot price, paper, and the street price, physical. The spot price is a synthetic derivative generated by futures contracts. The street price is what you actually pay. Even if the COMEX spot price stays at $90, the tariff acts as a floor for the physical price. No dealer can import silver from Europe for less than spot plus 10%. Therefore, they will not sell it to you for less than spot plus 15% or 20%. I want to hear from you on this point. What are you seeing on the ground? Are your local coin shops raising premiums yet? Leave a comment with your state and the price you're seeing. Let's crowdsource this data together. The tariff bakes inflation into the physical product. It validates the disconnect. We're likely to see a scenario where the paper price becomes increasingly irrelevant, serving only as a reference point for cash-settled contracts that never touch metal, while the physical price marches to the beat of its own drum, a drum beat by scarcity and taxes. Let's dissect the logistics of this trap further, because the devil is in the details, and details are what separate the wealthy from the hopeful. The global silver market operates on a system of unallocated and allocated accounts. In an unallocated account, you do not own specific bars. You own a claim on the bank's general pool of metal. It is, for all intents and purposes, a fractional reserve system. The banks hold a fraction of the metal they owe to customers, relying on the fact that not everyone will ask for delivery at once. London is the hub of this unallocated system. With the logistics line cut, the risk of holding unallocated silver in London has transitioned from theoretical to existential. If you are an entity holding unallocated silver in London, you are holding a claim on a vault that is being drained and can no longer be refilled from America. Rational actors will see this. They will rush to allocate their metal, to put their name on specific bars, but the bars aren't there. This creates a run on the bank, but for metal. When this happens, the banks usually declare force majeure, or settle in cash. They will write you a check for the value of the silver. But here's the rub. They will write the check based on the spot price, not the street price. If spot is $90, but physical silver is trading for $120 because of the shortage, and they cash you out at $90, you have effectively lost 25% of your purchasing power instantly. You have been bailed in. This is why we emphasize the Roach Motel effect in the US. While it traps metal here, making the US system more robust, it leaves the external system, the Eurocentric system, incredibly fragile. Consider the dilemma facing the Swiss refiners. They are the gold standard for quality. Pamp, Valcambi, Arger, Heraeus. If these nations fall under the tariff umbrella, or if the UK acts as a transshipment point for them, the flow of high-quality bars into the US stops. US dealers will have to turn to domestic refiners. But US refining capacity has atrophied over the last 30 years of globalization. This bottleneck creates a fabrication squeeze. It is not just a shortage of silver, it is a shortage of formatted silver. This further drives up premiums. We saw this in 2020 and 2021, where silver grain was available, but rounds were not. History is rhyming, but this time it is driven by government decree, not just viral panic. We often talk about black swans, events that are impossible to predict, but have massive consequences. The Greenland Tariff is the ultimate black swan. The algorithms that run Wall Street are programmed to analyze interest rates, the US dollar index, DXY, GDP growth, and unemployment claims. They are not programmed to analyze a real estate dispute over an Arctic island. The AI trading bots do not have a variable for President wants to buy Greenland, so he taxes London. This means the machines are flying blind. When machines fly blind, liquidity disappears. They shut off. This explains the volatility we are likely to see in the coming week. The bids, buy orders, will vanish from the screen because the algorithms don't know how to price the risk of a tariff war. This vacuum of liquidity allows prices to gap violently. We could see $10 moves in a single trading session. So, where does this leave us as a generation that values stability? We have seen the stagflation of the 1970s. We have seen the dot-com bust. We have seen 2008. We prefer data over hype. The data tells us that the era of globalization is ending. We are entering a period of de-globalization, characterized by friction, barriers, and protectionism. In a globalized world, you could hold assets anywhere. You could own a Swiss bank account, a London gold vault, and a New York stock portfolio, and they were all accessible. In a fragmented world, geography is destiny. First, geographic diversification is dead. The old rule of flag theory, planting flags in different jurisdictions, is now dangerous for physical assets. If you have silver in a vault in London, Zurich, or Singapore, can you get it? Can you bring it home without paying a punitive tariff? Can you sell it there if the market is frozen? The Greenland Tariff teaches us that the only safe jurisdiction for your metal is the one you live in. If you are American, your metal needs to be in America. If you're in Texas, it needs to be within driving distance. The walls are going up. Second, ignore the paper price. I cannot stress this enough. In the coming weeks, the television might tell you that silver is crashing or that it is soaring. It might show a price of $90. Do not make decisions based on that number. It is a broken metric derived from a broken logistical system. Value your holdings based on replacement cost. If you sold your stack today, how much would it cost to buy it back? That is the real price. With the tariff floor and the refining premiums, the replacement cost is significantly higher than the spot price. Third, prepare for the return of tangible wealth. We are witnessing the remonetization of commodities. When fiat currencies are weaponized through sanctions and tariffs, neutral, hard assets become the only true collateral. The US government knows this. That is why they are trapping the silver here. They are hoarding collateral. You should do the same. It brings me no joy to predict the demise of an institution as old as the London silver market. It has traded for centuries, but markets run on trust and flow. The trust was damaged by the nickel crisis a few years ago. The flow has now been killed by the Greenland Tariff. London is now a market of paper promises in a world that is demanding physical delivery. They will try to change the rules. They might increase margin requirements. They might expand the definition of delivery to include cash equivalents. They will do everything they can to prevent a formal default. But the relevance of London as the price setter is over. The pricing power is shifting. It is shifting to Shanghai, the consumer, and largely due to this tariff, back to New York, the holder of the trapped inventory. To fully grasp the magnitude of this moment, we must look back to a date that is etched in the memory of every person reading this, August 15th, 1971. That was the Sunday evening when President Richard Nixon interrupted Bonanza to announce that the United States would temporarily suspend the convertibility of the dollar into gold. He told the world that this was to protect the dollar from international speculators. Whatever the stated reason, the result was a fundamental severing of the link between paper money and physical reality. We are now witnessing the spiritual successor to that event, but in reverse. The Greenland Tariff is effectively the United States closing the silver window to the world. For those of you who remember that Sunday evening in 1971, I would love to read your perspective. Does the atmosphere today feel similar to the uncertainty of that summer? Does this feel like another major pivot point? Share your memories below. Just as in 1971, this move is being framed as a specific geopolitical negotiation tactic. But do not be deceived by the temporary language. In the world of strategic resources, temporary barriers have a habit of becoming permanent fortresses. What Nixon did in 1971 changed the psychology of global finance for 50 years. What has happened this week will change the psychology of commodity logistics for the next 50. We are witnessing the death of the just-in-time global economy. For the last 3 decades, since the fall of the Berlin Wall, the entire Western banking system has operated on the premise of efficiency. Why hold expensive inventory in a vault when you can just fly it in tomorrow? This efficiency, this leanness, was profitable as long as the borders were open and the seas were calm. But efficiency is the enemy of resilience. The Greenland Tariff has exposed the fatal flaw in just-in-time banking. If you cannot get the metal tomorrow because of a tariff wall, then you are not efficient. You are insolvent. This realization is currently sending shockwaves through institutional capital. We are not just talking about individual stackers anymore. We are talking about pension funds, family offices, and university endowments. These are entities that manage billions of dollars and have a fiduciary duty to preserve purchasing power. For years, these institutions were content to hold paper silver via ETFs or futures contracts because it was easy. It had low fees. It had liquidity. But the tariff war introduces a new risk that these conservative giants cannot stomach: counterparty risk derived from political geography. If an ETF stores its metal in London and London is cut off from the global market, that ETF is no longer a safe haven. It is a liability. We are already hearing whispers of a great rotation within institutional portfolios. Smart money is moving out of broad international commodity baskets and seeking allocated domestic storage. They want to know exactly where the bar is. They want the serial number. And most importantly, they want to know that the bar is sitting on U.S. soil, protected by the same tariff wall that is destroying London. This is the return of the just-in-case mentality. It is the mentality of the prepper, but applied to the balance sheet of a Fortune 500 company. Furthermore, this pivot is not limited to the private sector. We must look at the behavior of sovereign nations. If the United States is willing to weaponize tariffs to ring-fence its silver supply, do you think China, Russia, or Mexico will sit idly by? We are entering a period of tit-for-tat resource nationalism. Mexico is the world's largest silver producer. If they see the U.S. trapping inventory, they may very well decide to nationalize their own exports or demand payment in something other than dollars. This creates a feedback loop of scarcity. As nations and institutions hoard metal just in case, the float available for the open market shrinks even further. This is the mechanism by which a supply crunch turns into a mania. The parallel to the 1970s is striking. The 1970s were characterized by supply shocks, oil, inflation, and a loss of faith in paper promises. We are seeing the exact same rhyme today. The difference is that in the 1970s, the U.S. was losing its gold. Today, the U.S. is locking its silver in. This suggests that while the dollar may suffer globally as a trade settlement currency, the domestic dollar, backed by a trapped industrial base and trapped strategic resources, might actually strengthen in purchasing power relative to foreign currencies that are starving for raw materials. For you, the prudent investor, this reinforces the strategy of holding physical reality. When the just-in-time system breaks, the only thing that matters is what you have just in case. The institutions are finally waking up to what we have known for years. In a world of friction, possession is not 9/10 of the law, it is 10/10 of the value. Conclusion. Friends, we are living through history. This is not just a Sunday news cycle. This is a structural break in the global financial architecture. The Greenland Tariff may sound like a footnote in a biography of a president, but in the history of money, it will be remembered as the moment the silver market broke into pieces. The silver is locked in the room with us. The exits are barred. The banks can no longer play their shell games because the shells are glued to the table. For those of you who have accumulated physical silver over the years, ignoring the ridicule of the mainstream, your patience is about to be vindicated. Not because of a meme, not because of a squeeze, but because of the cold, undeniable reality of logistics. The metal cannot move, the shortage is real, and the price must now reflect the truth. Stay calm. Watch the flows, not the ticker, and ensure that what you think you own is actually within your reach. Finally, we know there are copycat channels trying to duplicate this deep dive analysis. If you value this original research and want to support the channel, please leave a comment saying "staying with the original" to let the algorithm know you are part of the real team. Thank you for reading and for being part of the few who look beneath the headlines to find the signal in the noise.